Good day, fellow investors. There was this great comment by Zero G where he discussed how the S&P 500 has significantly outperformed ADM over the last 20 years. What makes me think ADM will outperform the S&P 500 in the future? And that's exactly what I want to discuss here, because when it comes to investing, so many comments are about performing and outperforming. And when it comes to investing, if your focus is on outperforming something, that's an impossible question to answer looking into the future. In hindsight, it's easy what outperformed in this or that. But let's really discuss this a little bit deeper, because it answers one of the key misunderstood investing questions. Should I chase outperforming something, or should I just perform well for myself? If I look now at the S&P 500 dividend yield, it is 1.45%. If the market goes a little bit down, the yield goes a little bit up. But if we discuss the last 20 years and outperformance, so the market was at 1,145 points. That's a 4.2x over the last 20 years, 7.4 per year, at the average 2% dividend yield, and we are at the market return of 9.4% per year. Earnings went from 60, let's say, to the current 180. That's 3x growth. I didn't correct that. That's 5.6% yearly growth in earnings, which is not bad. But apart from earnings growth, there was also 36% valuation expansion from a P ratio of 19.25 to 26.30. And if I would revert the current earnings to the P ratio of 20 years ago, the S&P 500 would be down to just 3,522 points. And if we go to the average historical P ratio of 15, the current S&P 500 goes to 2,745 points for a big crash. So the S&P 500 performed thanks to, of course, earnings growth. Those are great businesses, 3x in earnings over the last 20 years, and an expansion in valuation. But let's look at ADM, which is what we are looking to outperform something going forward. The stock did 3.5x, not as much as the S&P 500, but we are at 6.5 yearly. There was an average dividend yield of around 2%, a little bit higher in the late 2010s, but the total return is a little bit less, so didn't underperform significantly the S&P 500. It is a little bit less, so 8.5%. Still good. I have looked at earnings, and net income went from $500 million to $4 billion now. I'm adjusting those earnings to, let's say, $2 billion to be just more conservative. So earnings did go up 4x compared to 3x of the S&P 500. So we have the S&P 500 that expanded on valuation, ADM contracted on valuation because earnings grew faster actually than the earnings of the S&P 500. And we had returns similar. But let's look at what can happen going forward. So ADM, they make $2 billion per year in value creation, cash flows, then distribute that in dividends. They grow, continue growing, food prices, thus inflation. And if they have a P ratio of 15 on the current 30 billion, 30 divided by 2 billion, that's 6.6%. Going forward, plus 3% growth, that's a return of around 10% going forward. Remember this earnings yield of 6.6%. If I compare that to the S&P 500, the earnings yield is 3.8%, which is much lower than the 6.6% of ADM. Going forward, return 3.8%, 2% growth of earnings, maybe a little bit more. So we are somewhere around 6 and 7%. But if valuations contract, then the index will also contract. So comparing the two, the P ratio there is much riskier for the S&P 500. The yield is lower for the S&P 500. and let's say the growth there is likely to be equal. So from this value investment perspective, ADM wins now. But who will outperform who? I don't know. I can just know, okay, what do I own and how do I like how that business does? Will that business lead me to my goals? Performance is such a volatile topic that it is crazy to even discuss it. And if you fall into that trap of performance, you start chasing it, and then you are not investing, you are gambling, and that usually leads to very, very bad returns. And I want to finish with this comment, great comment by Tsones. So it's tough to be a value investor at these times, when the stock markets are irrationally high. However, it's still unclear to me if the market has ever been rational to begin. Markets can remain irrational for longer than we can remain solvent. That is correct, but if we invest, no matter what the markets do, then we are real investors. And we need to seek those investments that will lead us to our financial goals, no matter what the markets do. If you depend on the market does 20 years great, but then the next 20 years might be ugly. And if you depend on the market, you are in a dangerous place.